The pullback we're getting today, the end of the week, is now below levels that we predefined, that if you'll close this week out below these certain levels, and we haven't closed yet, we've broken structure sufficient to argue, when I say structure, I mean momentum structure, not apparent on a price chart, that is likely to begin a decline from this, quote, breakout, a new high, and put us back below probably the highs we saw early this year, in which case people are going to start doing this, saying, well, I thought I had a breakout there. I thought it was going to go forever. That's what we look for. And I think this week is the beginning of that. And sure enough, today, when the stock market getting whacked, gold shot up 30, 40 bucks, silver shot up half a buck, and well off the lows we just made a few days ago. And that's the kind of response I expected. In other words, you break this big asset category and the money goes somewhere. It always does. And usually it goes into T-bonds and gold. And clearly gold has been a recipient for quite a while of money fleeing the stock market. And I think that's going to increase now with the perception that, oops, this new high in the stock market was a trap.
Hey everyone, and welcome to another episode of the WTFinance podcast. On this episode, I have the pleasure of welcoming back Michael Oliver. So Michael is a regular guest who is the founder of Momentum Structural Analysis. So Michael, thanks so much for coming back on the podcast.
Good to be back, Anthony.
Yeah, looking forward to speaking because it has been it seems like a very volatile market, but things have sort of been slowly drifting up, at least over the last few months after the Liberation Day sort of crash. But I'd be interested in hearing your opinion on what you see in the markets and the economy overall.
Well, as far as the U.S. stock market goes, and it is a distinct bubble, measured any which way you want. I mean, you go back 15 years to, 2009 lows, so more than that even. The increase, the multiple gain in the stock market, and the duration of the bull market, there's no comparison. Go back to the 29 top, the 1970s, .com, 2007, and no comparison. And you can say, well, the economy's been strong. Well, look at an M2 chart and you'll see the money pumping has been quite good. And look at the Fed funds rate chart and you'll see why free money, has had an impact. Essentially free money for 10 of the last 15 years. And even when they raised rates a bit, it was still in the lower quadrant of the past 75 years of rates. So anyway, we think it's topping. We think we put out a major negative get out of this market signal in January for the S&P 500. It took it a month or two and finally it puked, dropped down to a level that we actually thought would be a bounce point, 4,800 level on the S&P. NASDAQ 100 did something very similar, reaching a bounce point. The bounce was stronger than we expected. It came back and made a new high. And that's not a real shock to us because when we call the 2000 top, the .com top, and let's say the 2007 top, if you go back and look at the price action of the stock S&P 500 during that 2000 year, the topping action, and 2007, you'll see what's we would call an arduous top, meaning a lot of up, down, teasing new highs, marginal. That didn't really go anywhere. It was topping out. Momentum had already declared you're dead. Okay, but price said, oh no, I'm not. And it struggled, but it didn't really go anywhere. So if you got out when we said get out, you didn't miss anything. And in fact, you avoided hell. Okay. This time, I think it's far worse. The consequence will be because of the nature of the bubble and its impact on other areas, not just the stock market. Okay, so we think in January, one should have left the market. Okay, now it's gone up in the recent high 3 or 4% above that high that occurred either in late 24 or early 25, depending on the index. And of course, a lot of indexes, subsectors of the market, have not made new highs in this move. They've come back up close. Some of them haven't even come back but halfway to that high. So it's really not broad at all. We saw a good example of that yesterday when Microsoft and Meta, Facebook, had stellar earnings reports and they gapped up real big. Again, this is the Magnificent 2 now. The Magnificent 7 doesn't exist anymore in terms of being a solid body of leadership. And somebody said, heck, I'm out. And they dumped on it right there, especially Microsoft. Look at an hourly chart of what happened yesterday. Anyway, so what? The pullback we're getting today, the end of the week, is now below levels that we predefined, that if you'll close this week out below these certain levels, and we haven't closed yet, we've broken structure sufficient to argue, when I say structure, I mean momentum structure, not apparent on a price chart, that is likely to begin a decline from this, quote, breakout, a new high, and put us back below probably the highs we saw early this year, in which case people are going to start doing this, saying, well, I thought I had a breakout there. I thought it was going to go forever. That's what we look for. And I think this week is the beginning of that. And sure enough, today, when the stock market getting whacked, gold shot up 30, 40 bucks, silver shot up half a buck, and well off the lows we just made a few days ago. And that's the kind of response I expected. In other words, you break this big asset category and the money goes somewhere. It always does. And usually it goes into T-bonds and gold. And clearly gold has been a recipient for quite a while of money fleeing the stock market. And I think that's going to increase now with the perception that, oops, this new high in the stock market was a trap. Okay. So that's where I think we are. And I think the stock market, therefore, is important to people looking at the gold market.
Yeah, really interesting. Thanks for laying that out. And how are you looking at the economy? Because it seems like, we got some data out today. We're recording on the 1st of August.
Yeah.
Lots of job revisions sort of down. Basically, most of the jobs that they expected in sort of May and June. So do you see the economy going into a recession as well?
Yeah, no, it's or worse. When the stock market tops 2000, 2007, the data points that people like to look at for economic health or weakness almost always lag a topping of the stock market. In other words, it's not until you break the stock market sufficiently and convince enough folks that, oops, this really has been a top or it's a questionable market, that's when the data points start to head south. The kind of data points that Powell likes to look at, when he says the economy's strong, which is a lot of baloney. Because if you look at the unemployment reports, or the employment reports rather, of the last 6 months, and look inside and see where the gains in jobs were, it's invariably government, state and local sometimes. Last month in particular was state and local. Hospitality, and good grief, we do need waitresses and bartenders, not to diminish them, but that's a big job growth area. And home care workers is another area. Not so much in fact, it's flat to negative in most of the what you would consider industrial related sectors. So the job market really hasn't been as good as Powell likes to tout anyway. And once he gets smacked in the face with some data points, a couple more reports like today on the job market, then suddenly these two voices on the Fed are going to be 3 or 4 voices on the Fed, and he's going to look like he's in an awkward political position, because at that point he's got enough Fed members telling him, shift, do what Trump says because we agree with it, and in which case he's going to look political if he doesn't start cutting rates. Because if the data points head south, then he's got no excuse not to cut rates. Anyway, so I consider all that stuff really a lagged indicator. In other words, what the economy does will occur, but it'll occur after the market has already smacked you in the face. And I'm not so sure how deep, economically speaking, not just market, but economically speaking, this downturn in the U.S. stock market bubble will be in terms of everyday life. Recession can be thrown out there, but, I'm not so sure that it couldn't be worse. Because, again, we have the biggest bubble in U.S. history. And if it expunges the errors it's made over 10, 15 years of false printing of money, artificially low money rates, then good grief, who knows what the consequences will be. They could be here, there, and everywhere. And so I can't speculate on that except to say this is a huge bubble. And by the way, the bubble here is not really reflected in a lot of other markets, particularly emerging markets. China, they're not bubbles. And they're in positive mode as far as our assessment is concerned. Now they could switch and roll over with the U.S. market, but they're not bubbles, so they don't have the vulnerability that we do. We're pretty unique in that regard.
Yeah, great. Makes a lot of sense. And have you been surprised that Powell hasn't cut rates quicker? Because it does seem he's getting to the point all the data is looking negative, but they seem to still say the economy's strong and keeping rates strong. It seems quite surprising.
Yeah. Well, he's going to be faced with a real problem, because it's still our conviction that the commodity complex, the commodity category, is still very depressed. If you look historically at the price level, like the Bloomberg Commodity Index now, where it is now, just above 100, compared to where it was in 2008 or 2011 in the 200s and the high 100s. It's still low. It has a technical base that is quite stunning to us, not on the price, somewhat evident on the price chart even, but especially on annual momentum, that you get about 5% above where we're trading right now, and you're going to blow that base out and break out, in which case there's another wave of upside in commodities. It hasn't occurred yet. Even oil, which has been sort of a laggard over the last, especially this year, well, a lot of commodities have been firming or steady. Oil had this puke, where it dropped below 65 down to 55 and took out a whole bunch of price lows of the last couple of years around 65. Well, we thought that was a trap, meaning not a sustainable downside break. And sure enough, it aborted back above that, and is now, 67, 68, and it even traded over 70 the other day. You close out any month in this quarter, that's this month or next, at 70 or higher, quarterly momentum of oil says you're going up, and you could go up pretty sharply. Now, I don't know what the reason will be. I'm not going to worry about that, but it's got major buy signal pending structure on crude oil, which of course is a hefty component of the Bloomberg Commodity Index. And that would be a very big upset factor, not just to the Fed, which has dual mandates. If one of them says cut and the other says, gosh, we can't cut, they're really in a pickle. But it's a political upset to Trump. And I think one of the things you've got to look for in this environment, especially in the coming rest between now and the end of the year, for example, is upset. Meaning things that people thought would happen don't happen. In fact, they go the other way. And one of the things he ran on that was a core essential that attracted many non-Republican young voters in particular was the notion that I'm going to keep your prices down. And of course, one of the most glaring prices that anybody faces day to day is when you start pumping gas and suddenly the price of gasoline's gone up $1 a gallon or $1.50 a gallon, et cetera, and that promise goes out the window. So the assumption you had that he was going to keep things contained goes out the window, in which case you gave up on the Democrats. They're fractured as a party. And suddenly the Republican Party which is getting more and more fractured, by the way, anyway. The old conservatives in the party have long since abandoned Trump. And if Trump suddenly looks like he's failed, especially in regard to keeping cost of living down, then that's an upset factor. And so when people are upset, their wife got laid off, you got laid off, your credit card's at the limit, you're past due, you can't pay your taxes this year, so you figure out I'm just not going to file, or I'm going to ask for an extension. All these things come together and creates emotion. And I think that is on the cusp right now, especially if the stock market does what we think, which is to say, ooze back below that old high and upset the notion that, we were going up forever. Now we're not. Okay. So, in other words, emotion could come into play, I think, in the next 6 months.
Yeah, it does seem to be a trajectory. And what do you think for the bond market? Because I guess, as you said, historically, it's been a safe haven. It's sort of yields would decrease when you're going through this recession, but it hasn't seemed to have that correlation. Do you think
it has not worked out as an alternative this time? When the stock market broke from January through April, the bond market, gold was going up. It surged from early year to April while the stock market was going down. So money was moving into gold, but it wasn't moving into T-bonds. Now, right now, we've got a little rally going, a couple points in T-bonds for the last couple of days. But when you look at a long-term, even just a price chart of 30-year T-bond futures, or look at a yield chart, long-term rates, don't look at the short-term, it's clustered. You're really just stuck in ink sideways, but at very low levels on price, very high yield levels, in which case it almost doesn't matter whether rates go higher. It's just hanging around here is like a noose on many corporations, which have, as I understand, a lot of commercial real estate has debts coming due this year and next. So, they're not getting any relief, just if rates stay where they are. Now, the question is right now, is this T-bond rally we're getting over the last 2 days finally going to join gold as an alternative? I have my doubts. I'm not going to say it can't, but it hasn't so far. And frankly, we've got numbers below the market, which it has not yet triggered. I'm talking T-bonds now, T-bond prices, that if they get to you're going to have a mini panic in the bond market as well, to the downside in price, upside spike in yields. That hasn't happened yet. And the question is whether the government can keep it from happening, because we know they have a major debt problem. And it's, I don't, like Jamie Dimon has said, I don't think this time they're going to avoid it. So anyway, we'll see. But as far as an asset to buy to protect yourself against a losing stock market, so far it has not done what it normally does.
Yeah, great. And what do you see happening with, I guess, the deficit? Because as you said, Jamie Dimon saying it's an issue. It seems to be
comment on that. It's no comment on that. Obviously, if the economy weakens, then tax revenue is going to slop down as well. And we think a lot of changes could occur that are not just market or economic data points. If we go into the upset that I described, because certain factors engage now, let's say a downside stock market, therefore the data points head south, people's pain, personal pain gets even worse than it is now. Again, a lot of families are up to their head in debt and credit limits. That certain institutions and notions that have prevailed for 100 years might go out the window. Wouldn't shock me there's no Federal Reserve in several years. Simply because, hey, it hasn't worked, guys. It's been boom bust cycle monetarily, and therefore boom bust cycle in the stock market. And more people are becoming aware that, this entity is not some savior. It's part of the problem. And if you get into an economic crisis, real in the street type crisis, where people are hurting, that's when things like that get doubted. Okay. Another one could be if we head into an economic downturn, the question is, what's the viability of the public to pay their taxes next April? People are hurting. It's hard to write that check, if you don't have the income, and therefore you're either going to be late, you don't file, or you're going to ask for an extension, or, in other words, suddenly government revenue from taxes could go whoop down. And it wouldn't shock me if they get severe enough, they abandon the income tax totally. Why? Because it's not viable as a source of income. And they turn to something else, like a national sales tax, for example. But all kinds of these variables are out there. I'm not predicting which will occur, but I bet some of them occur. And it's a 52-card pickup time coming. Watch that stock market. I think gold already knows what's going to happen. Namely, you're going to have a crisis. And it's going to be basically the key alternative, it and its fellow travelers, silver and the miners.
Okay, and what are you seeing in sort of other markets globally? Are you watching Europe or China at all?
Europe has had a big shot up lately, and no doubt they'll come down too. Because again, it's not just, we've got a bubble, and if our economy turns down, you can say, well, this economy is doing well, but we're part of a world economy after all. And if you take a major country like the U.S. and suddenly kick it in the gut, you can have wave effects elsewhere in terms of, how much they produce and sell to us, or, et cetera, et cetera. So it's not going to be limited to us. So it's hard to say fundamentally how some of these other markets that look technically better than ours, less vulnerable, particularly China. In fact, China is in a positive momentum trend by our assessment. It could change that. But again, if it turns down, it's not going to turn down like the U.S. So, if somebody came to me and said, I've got to have position in the world stock market, what do I do? I would say, well, go market neutral. be short the U.S. and be long emerging markets, which, EEM, the ETF, very popular ETF, it contains, I think, about 30% China stocks. Also Taiwan, South Korea, and a lot of other emerging markets around the world, and to a lesser extent, India, for example. But I think, owning that and being short the S&P, I bet you make money on the spread. Meaning, even if the emerging markets go down, they're not going down like the S&P, in which case you make money on the difference. So that would be a sort of a protective way to put your helmet on for the next year or so. Anyway, that's my thought on that issue.
Okay, yeah, thanks for laying that out. And yeah, you mentioned gold obviously as a protective asset to
well,
wealth.
Obviously, that's where I am. In fact, I'm emphasizing silver in my positions personally.
Okay. And yeah, is there anything else that you're sort of looking to see, or do you think it's going to be a complete risk-off sort of scenario in the coming months?
I think I think gold and silver are already on their way up. I mean, silver had this dump recently that, it was 4-week dump, but really it was one bad day. And if you go back over the last couple of years and look at silver's rise, go back, for instance, after silver made a high in 2020, got up to just short of 30 and fumbled around, and then pull back for the next couple of years, and like an overlapping pullback. And so did the gold and silver miners. They paused and pulled it, but whereas gold literally went sideways during that time, so it outperformed them by not going down really, whereas they corrected down. That's shifting, favoring them now, silver and the gold and silver miners. But I see, when people get panicked by any quick pullback in silver, they need to stand back and look at what's going on. Where was silver a year ago? Where was it, for example, in March of 2024, when we put out a report to all our subscribers saying, okay, the dull markets we've seen since mid-2020 on gold, silver, and the miners, which have just put everybody to sleep or scared everybody because of their non-trending upward, but they didn't break the long-term trend that we measured. They went sideways, really. That was going to regain its upside potential at that point in March of 2024. Well, silver was $25, $26 then. Where are we now? 37, 38. So, it's not like it hasn't advanced more or less continually, but it's had a lot of protracted stalls and pullbacks. In fact, we just went through one. Like, you go back to May of last year when silver hit 32.70 after our signal at 25 to 26 bucks in March. By May, it was up to 32.70. This is May of 2024 now. And then it started to go sideways for a year with higher highs and lower lows, but basically a random sideways movement until June of this year. And that's when we put out a renewed signal again saying, okay, pushing up in the high 34s, we're going to accelerate now. But yeah, we just had a pullback. We're trading at 37 now. Okay. I think we're in an accelerated phase for silver and the miners and gold in that order. Meaning the upside we've seen in this arm wrestling process is now going to go more vertical. And I think one of the factors that will spark that, will stimulate that, will create capital flow is money moving from the stock market, particularly when it moves into the teeny tiny little sector, the gold and silver miners, which is, after all, part of the stock market. And we've seen lately an unusual strength in the gold and silver miners as a category relative to gold even. And I think that is partly due to money getting more and more nervous about the stock market and saying, hey, we need another place to be. And good grief, these guys are actually making a lot of money per ounce, and we've ignored it. And now we're going to get into that tiny little category. And that's why you have this wet bar of soap type phenomenon where, we're going up pretty sharply and more so, I think. So anyway, that's where I would be for the next 6 months, especially, but probably over the next year and a half as well. But right now, I think there's going to be some drama between now and the end of the year, more than we've even seen so far. And I think gold's totally comatose sideways for 4 months now. April, May, June, and July close on monthly close. You could draw a line right through them. Gold never tops that way, by the way. Never. It spikes when it makes a high. This is total lateral sleeping sideways, while gold and silver went up during that time. When gold reasserts itself back over 3,400, especially 3,500, I think you're going to see a dramatic flow of money into that category again.
Yeah, it makes sense. As you're saying, the miners have really lagged the commodity, so it seems like it's sort of time for them to
That's
catch
changed.
up a little bit. Yeah.
Yeah.
No, definitely makes a lot of sense. And how do you know? Do you see this being like quite a monumental sort of crash? I think you talked about previously that you think it could go, quite low.
I think the key issue for the miners is, and I know a lot of people are fixated on the notion that if the stock market goes down hard, so will gold, silver, and the miners. Well, first off, it's not true. You go back and look at the bear markets. Well, just over the last 25 years, 2000, 2002, gold, silver, and the miners went up. 2007 to 2009, okay, up. They were an alternative. Sometimes you'll get an emotional week or two in the stock market where you get effectively a crash type event. Though that's kind of rare in bear markets in the stock market. In fact, the 2000 to 2002, there was never a crash. It was just a bloody downside that was just constant. It was without a crash event. And in 2007 to 2009, there was 1 month in there in October 2008, a full year already off the high, well off the price high. You had a crash-like event. And at that time, gold, silver, and the miners all did have a sympathetic pullback. But in the context of the broader bear market, they were going up. For them, that was a corrective drop. And I think the recent example is pretty good. Look what gold did. January through April, while stocks were puking, went up. Anyway, that's my view of the world here, and I think we're about to get back to a more dramatic behavior in the markets, both upside the monetary metals and downside in the stock market. Once we convince the ever bulls that this time it's not going to do what you think. It's in fact more like the 2000 top to 2007 top, arduous, with teasing new high.
So this time is not different. It's the same as all other cycles have to come to an end.
Yeah.
Then I guess there is a talk that there's so much liquidity, as you said, there's so much M2 being pumped into the market, and maybe that's going to keep.
Well, recently it started. If you look at the M2 chart, they've put the pedal to the floor. Don't worry about rates. What really matters is what the Fed doing with their money, and that bond market better not slip back off this rally and start back down again, because that'll really panic them. But once you get the negative data points, they're going to have to respond with rate cuts, or Powell's going to look like he definitely is playing a political game. Right now, he's playing an academic economist game. At least that's what he's saying. But once the data points start south, he's got no excuse anymore, in which case he's got to go put the pedal to the floor again, or retire with a bad name. But it's not just the rate cuts. It's a monetary policy. And I think that is already, looking at the M2 chart, something's changed. For the last 9 months or so, this thing started to go vertical again. So that's what really counts.
Yeah, makes a lot of sense. So, Michael, thanks so much for your time today. We sort of covered
Thank you,
a lot
Anthony.
of things. So, my last question is, what is one message you want people to take away from our conversation?
Next 6 months will be dramatic. Be on the right side of them. You'll do well. The drama isn't necessarily negative. If the stock market goes down, that could be a very positive thing, in that it's cleansing that which should never have happened in the first place. And once it cleanses itself at some deep level and with a lot of pain, then maybe it'll get back to normality. And maybe we won't have a central bank that prints it higher next time. Maybe it'll go up next time for real reasons. Anyway, that's the world we're facing. It's going to get very speedy between now and year end.
Great. So, yeah, thank you. Thanks again. If anyone wanted to find out more about your work and what you do, where would the best place for that be?
olivermsa.com. Take your time. We discuss our unorthodox methodology there, and you can request sample copies as well.
Great. I'll put it in the description below, but thanks again for your time.
Thank you, Anthony.
Hey, everyone. Thank you for listening. I really appreciate the support. If you've got value out of this, I'd really appreciate it if you could like, subscribe, or comment, you know, good or bad feedback. I'm always open to that. But it really helps with the channel. As I said before, only about 14% of people actually subscribe to this channel. So if you were to that, it would really help. It could mean we could continue to grow. If not, thanks for watching, and see you on the next show. And you also might like this video right here. All right, thanks again.